Good evening, participants, and thank you for dialing in today's webinar with our Global Equities team from Marcellus. My name is Hardik Nayak, member of the Client Advisory and Relationships team, and I'm going to host the webinar for today. So this investment offering is now close to 2.5 years. We've been managing this portfolio from Gift City. If you could display the slide of performance, we could be able to show to our clients what has been our track record so far. Coming back to today, I mean, it's been an interesting turn of events in the last few days, particularly, that the government of US, we've seen how tariffs have come and gone to some extent, and the entire stock market has particularly been impacted. What we're going to try and do today is we'll try to understand this a little better from our global team today, who's here to present us their views. We have Arindam Mandal, who's head of Global Equities. We have Jebir Sethi, who is head of research for our Global Equities team. And, we're going to ask a few questions to Arindam to try and address some of the things that a lot of people have been talking about, but particularly from our portfolio's point of view, how we stand today. Now, before I hand it over to Jebir for the interesting questions that he has planned, Arindam, I have to start by asking, there's a lot that has been sort of happening in the United States, the tariffs and the U-turn on tariffs. What has been your overall reading on this? How are you dealing with this and the portfolio?
Sure, Hardik. We'll try my best to do that. But good evening, everyone, for your time and joining in. So, Hardik, yeah, you're right. Absolutely. Lot has happened in last 45 to 48 days. In fact, if we just look back, the tariff related things kind of got everyone's attention like in this month. But the market peaked on Feb 19th February, the market peaked. And between Feb to March end, S&P was actually down by around 7% or slightly more than that. And that is when we started to get, some color around what the new government is going to do in terms of, putting tariffs across, their allies or not so close friends, if I can put it that way. So that is when these headlines, the first box that you can see here, those headlines started to come in, right? The tariff announcements against Mexico, China, Canada, etc. Then again, of course, I think second, third, fourth April, I think everyone probably is kind of, are aware about that, what is going on. So there's a huge list of, kind of countries against whom different rates of tariffs are imposed. And we called it like Liberation Day, 2nd April. Again, for a couple of days, S&P again lost around 10-12% of their value. And then again on 9th April, there was a kind of there's a 90-day waiting period was imposed on a few of the countries, barring China, right? So as you can imagine, or actually it is hard to imagine, that S&P was actually up almost 9.5% in just half a day, like in the second half of the day. So just think about it, in probably 4 or 5 hours, S&P kind of added a market which is equal to India's total equity market, right? So the 30, 35, $40 trillion market that went up by around 9 to 10%, right? So yeah, quite volatile, quite eventful, but yeah, that's where we stand.
No, absolutely, quite interesting. Jebir, I hand it over to you for the interesting questions that you've planned here.
Thanks, Hardik, and thanks to everybody who's joining us this evening. So, Arindam, these headlines are quite impactful. The market's been volatile, but how do these actually translate into more fundamental metrics? Because those metrics will not be as volatile, but will have more meaning over the next sort of year or two.
No, you're right. You're right, Jebir. So look, so there we can look at this in 3 ways, right? Three set of problems. So what we try to do here is that instead of we trying to guess things, I mean, which is incredibly difficult, what you try to do is, like find out different sources, what different, brokerage houses or some people you follow, what they're kind of saying. So there are three things here, right? Number one is, what would be the impact on the EPS numbers, right? So for example, if you are investing in India, so there's the underlying index is Nifty 50. So you typically get a Nifty 50 EPS number, right, on an aggregated basis. Similarly, for S&P, you get an EPS number. So we wanted to figure out that, okay, what can be the impact of the effective tariff rate, which is kind of a trade weighted way to kind of put like how much of price will go up, etc. on select things, right? So that's the effective tariff rates. So what I think Goldman Sachs came out with in one of their notes that with every 10% increase in value of trade weighted dollar, that would reduce S&P's earnings by around 2 to 3%, 2 to 4%, something like that, 2 to 4 actually, yeah. So now, if you think about the effective tariff rate based on what the U.S. administration actually proposed, if we take that value as a face value, I think it will be much lower than that eventually. But if I take that as a starting point, you're talking about a reduction of somewhere between 4 to 8% just because of the tariff increase, right? Then the second point is around inflation, right? So if these things are imposed, then what kind of inflation that the consumer might face? So again, there's a paper published. There's a Richmond Fed. So there's an empirical study that was done. You can find that paper, the link of that paper in a Richmond Fed website. But they're talking about from their empirical study that they did each 10% increase in tariff that translates into 2% of increase in raising the producer prices. Now half of that will probably be borne by the producer, so there will be hit on margin, and probably the rest half would be borne by the consumer. So practically, we are talking about maybe if it's a 20% effective tariff rate, we're talking about the CPI might be impacted by somewhere between 1.5%, right? So I think yesterday you got the CPI data. It was around 2.4. So you're probably looking at somewhere between 3.5, or 4, somewhere between 3 to 4. 3.5 probably is the right number. So that's the number to the second thing. Now the third leg, which I think is very, very hard to estimate, is that the second or third order impact. Like if we go into a recession, given that there will be stress on consumer, there will be stress on the business the profit margins of the businesses, and if that spirals down, then that is something that it is very, very hard to predict. So that is something we can call it a proper recession, but that is probably not the best case, especially the numbers that we'll be talking about today. And when I say proper recession, I'm talking about plenty of job losses, your unemployment going above 5%, like consecutive quarters of negative real GDP growth. These are not technical thing, real GDP growth, right? So yeah, so that is not the base case assumption. So based on the other things, so inflation and EPS impact, that's what is probably something more relevant to discuss.
Thanks, Arindam. So this the US has seen periods of economic turbulence in the last few years. Even if you leave out COVID, there was the previous trade war, there was the rate hike cycle post-COVID. So how have those sorts of events impacted earnings? And does this look in the same ballpark as those?
I think there is you can take some cue from that for sure. For example, we talked about 4 to 8%, say 6, 7% midpoint of earnings drag or earnings cut from what is happening. So you take higher side on the 8% EPS drag at the index level. So in 2018, when the first version of trade war that you saw, the red bars are actually how much S&P's earnings were taken down by that. So S&P's earnings were revised down by around 6% in 2018. Then in 2022, which was the second risk that we spoke about, which is higher inflation and consumer kind of struggling. So during that time frame, what we saw is like, the earnings revision got, the negative earnings revision was around 10%, right? So low double digit. Now it can be a combination of both, in which case the number can, go up a little bit. But broadly, this is, I think, a good starting point. How the earnings can be impacted. Now, if I look at, the kind of companies that we typically invest in, what we did a very simple study, so just took all the investing companies for Global Compounders Fund, and just tried to look into like what is the average earnings revision for this set of companies. Okay, um, for in during 2018-19, there's practically nothing. In 2022, there was around 3.5% of downward earnings revision. Again, these companies are much more resilient. They do exhibit a lot of pricing power. So as a result, and they're kind of, the kind of products which are not discretionary spending oriented. They're kind of more need based, right? So the drag on earnings are much more lower from that standpoint.
And in these previous cycles of macro turbulence and these significant earnings cuts, how did those translate into market reactions?
Yeah, that's a good point. So it is actually interesting. So during 2018, the market peaked to trough, right? So that happened in almost 3 months. It went down by 20%. In 2022, um, you know, since the earnings cut started to happen from there to where it bottomed out, that was around 16-17%. In fact, if you look at absolute market peak in 2022, it was actually around 25%. So 19, somewhere between 16 and 25, and then this time in first, what we have seen in last, say, 48 days, we have seen a 19% of correction. Now, I think the another relevant question that data point that might be interesting is how quickly the market bounces back. So in fact, if you look back in 2018, it took almost 4 months for the market to get back to the same level. In 2022, it took almost almost 8 months to get there. We have just a couple of days. We have definitely seen a big rally, but again, so these are all historical precedences. But we'll see how it plans out. But typically, the recoveries have been within a year or so.
Given this recent bout of volatility that this chart shows, how has GCP performed amid all this?
Yeah, so we did basically, there are two things that you can see here. So there's from market peak, so 19th Feb market peak, and 4th April 25, second day of tariff announcement. If you see, S&P went down by around 17%, 17.5. GCP went down around 11, 11.5. Year to date, GCP is down high single digit. I'd say S&P and the other indexes, they're kind of down in teens, right? So GCP has been resilient from that standpoint. I would say it is a defensive portfolio, right? I mean, that's how we wanted to build it. So that defensive characteristics is kind of showing up the performance.
Oh, this is quite impressive. Typically, these defensive characteristics also come with a trade-off of not keeping up with the market during good times. So, how has GCP performance been in sort of the last good couple of years?
Yeah, just let me pull the data. Yeah. Okay. You're right. I mean, so since we have launched, which is around 2.5 years actually, what I have seen is the first 22 months, 24 months has been pure bull run. So we still did, these defensive companies, but they still did better than almost 8-9% better than, the market on CAGR basis, probably 4 to 5%. But at the same time, it was comforting to see that, we have always spoken that GCP is a very defensive portfolio. It is not as volatile as other companies, the most popular names in the world. But we have backtested those things in terms of fundamental stock price. But when it actually really plays out, that kind of showed up in last 48 days of GCP.
Understood, sir. Thanks, Arunam. So you've effectively shown us what the market is worried about now, the headlines, the potential impact, the portfolio. But this thing of the market worrying about something is not necessarily new. Now, in previous such cycles, what are some of the indicators which have captured market worry?
Yeah, you're right. I mean, every time it is different, right? So if we just try to look into last few drawdowns, right? So one time, like in 2022, of course, there's a major inflation shock that happened. So at that point of time, again, there are a lot of other variables that were there, but the most important variable at that point of time was CPI. So as you can see, when the CPI index peaked, which the blue line is the S&P 500, so that bottomed out at that point of time. Similarly, if you think about when the during 2020, the last few months of 2023, right? So there was a spike around the bond yield, the government bond yield. So that peaked out in October 2023, right? So it peaked out around 4.8, 4.9%, the bond yield. So since then, the market saw a kind of pure rebound at that point of time. Uh, Similarly, what has been driving this time is something that what you call, there's a index called US economic policy uncertainty, and it has been there for a long time. So if you look at what happened during 2018-19, when the index went up, right, this red line, that is, it kind of reached, it's close to its peak level. That is when the market actually bottomed towards the end of December 2024, December 2020, 2018, sorry. Now we are kind of seeing the same thing, on the right side. If you see, this is this year, like what is going on. The economic uncertainty index, it is kind of reaching its peak, and the market is actually, I think it is kind of looking that data point. When you will see some stabilization there, I think there's a good chance of market kind of getting back.
And given all these, or given this big worry the market has around policy uncertainty and the worries that you've highlighted around earnings, what do valuations actually look like, right? Especially after the correction we've seen so far this year?
Yeah, so very interesting actually. So if you look at the long-term valuation of S&P 500, so if you look at say 15-year median valuation, that is the yellow block there for each of these markets. So for S&P, that stands at around 17 times. Okay. Now, if you just take out few of the larger companies, right? So if you take out those mega caps, some of those mega caps, then the second bar chart actually that becomes more important. So it is an equal weighted measure of that 500 largest companies in the US. So that number stands at around 15.6 times, which is actually slightly below compared to its longer term average. Now, having said that, we are yet to see that earnings cut that are going to come. But again, remember always that market tends to react much earlier than the real earnings cut happening, right? So broadly, I would say if you are you want to be probably in the quality side of it, which is the larger cap, that there's a lot of value that exists there. And in fact, if you look at, we get a lot of questions around US is pricey, the other markets are cheap, etc. But if you look at, for most of the markets, there is a reason that US is pricey, right? I mean, US, the ROE, the return on equity is always much higher. But for even other markets, they're kind of, the current trading multiples are actually either in line or slightly above compared to their 15-year average or median multiple, right? So from that standpoint, we feel that, the highlighted block here, that is actually, I think, quite a nice place to shop around, because, the table that you can see at the bottom, that actually speaks about last 20 years of or for some certain indexes we don't have 20-year of data, but the longest period available, what has been the earnings CAGR in terms of US dollar. So you'll find that consistently US is among, in terms of EPS growth, they have been there for a long time. In fact, 20 years is actually a long time. In fact, that includes the emerging market rally that happened in early 2000, right? So 2005 to 9-10, that's a massive emerging market bull time, and then GFC, etc. There's a lot of periods that are included in that. So I think that's a good starting point, that you probably get a reasonable earnings growth, and you're kind of getting closer to a multiple which is probably in line with what the historical multiple has been, right? Similarly, if I just convert it into a PEG ratio, so if I just take that multiple and look at what is the potential earnings growth based on consensus estimates of these different indexes, we just compare India and US here. You can see that like the S&P 500 equal-weighted index and or the mid-cap index, they are actually, compared to their growth potential, probably the PEG ratios are actually much lower, which is a great sign.
And given this market context of valuations, I'm assuming that GCP valuations are probably a bit higher, especially given your earlier comments around defensiveness and higher quality nature of the portfolio. But how have those valuations behaved? How has the portfolio valuation band actually moved?
Yeah, you're right. Look, I mean, these are high quality companies, so have to pay up a premium, right? So there is no doubt about it. In fact, most of our companies are growing at teens. In fact, if you look at longer term EPS compounding of S&P 500, that is around 7 to 8%. You get 1.5 to 2% of dividend yield. Right. So from that standpoint, I will say that you have to always pay premium. But if you look at this thing, this chart, what we try to do is we try to look at our portfolio, the weighted average EV/EBITDA multiple of our portfolio, okay? And it is relative to the market. We don't want to do absolute EV/EBITDA. The reason being, the cost of equity is a big input, the most important input when you're doing a DCA for any kind of this kind of valuation. And practically no one knows that. So we don't want to second guess that. We believe that the market multiple will capture that part. So with respect to that, where does our portfolio stands now? So from that standpoint, if you see, the portfolio's relative valuation actually has been coming down, which kind of probably answers your question, like the relative valuation of this portfolio only has gotten better. So even if you're kind of concerned about the headline valuation of the index, probably the portfolio is kind of a little bit more protected from valuation perspective.
In a way, what your earlier chart showed about how equal weighted S&P has now trades at a discount to its own history, whereas S&P trades at a slight premium to its own history. My inference would be that GCP portfolio has followed the trend that the equal weighted S&P has seen, and not what the headline S&P has seen.
That is right. Yes.
Understood. So, now, given all the macro worries that you talked about, one worry which predated all of this was that the US consumer was a bit weak. Things were a little patchy even last year. If I think of some of the discretionary company results. So, and now with this heightened policy uncertainty and the new set of macro worries, there's probably even more worries about the US consumer. So against that backdrop, how are you thinking about it? Do you share some of those concerns? Do they show up in the portfolio?
Well, let me say that, we are, you're right. I mean, US GDP, 70% of US GDP is tied to consumption. In fact, US actually consumes almost 30% of, 30% of world's consumption is actually consumed by US, right? So it's a very important market. And some of the indicators that are popularly, cited, which is consumer confidence index, like University of Michigan produces one. Those numbers are not, they have not been great in last probably 2 years actually, right? What we did is like, we have very limited exposure to direct consumer. Okay, we have very limited exposure. If you look at it here, when I say direct consumer exposure, we are probably talking about, a bit of like some of the where you are saying like the armies or a bit of Google, right? Because they have ad tech business, things like that. So that portion is around 18%. And if you look at sector basis, that exposure we have, if you can see here, consumer discretionary is just 9%, right? So again, we are not that big with the consumption theme, as you have highlighted before as well. When you launch the portfolio, that we are not. That is probably the smallest portion within our portfolio. So yes, we do understand there can be a ripple effect, right? I mean, if the consumer is not spending, it will eventually flow through in different sectors. But when it comes to direct consumer exposure, it is very limited.
Understood. Now, earlier in the discussion, you talked about how you don't think this will be a really deep recession, right? And there's the more technical kind of recession that we had in, say, 21, 22, or there is the deep recession that the US saw in 2008 or during COVID. And so far, your statement seemed to suggest you don't expect a 2008 style recession. So could you sort of highlight some of your reasoning behind that? What are the data points that you're looking at that are driving that view?
Yeah, and I mean, that's a great question, Javier. I would say that, I'll put it different way, that it is hard to know if a recession would happen or not. But it is pretty fair to say that if that happens, it is not that US as a market will get affected alone, right? The entire equity asset class will be pounded. Having said that, I mean, we typically look at, a few data points. For example, we non-farm, again, these are based on historical, the data that we have seen. Typically, when the US non-farm payroll, that goes below 100,000, right? So that is when you see that, the job creation is a problem. And when job creation is a problem, that actually eventually flows through the consumer spending, right? Or so we have not seen that yet. So in the top chart, you can see before 2007-8, the non-farm payroll was below 100,000 for an elongated period of time before the real recession actually took place. So if you look at the current one, the current scenario, which is the bottom chart, the job creation is actually, happening at a very, very, I mean, I'll say it is actually fine. It might not be roaring what it was during COVID, but it is fine. Similarly, there is some another data point that we typically keep an eye on, which is the retail wage growth. So basically, what you want is the you want the wage growth to be in the positive territory. What that means is that they should be saving at least a bit of it, right? So if it is adjusted by inflation, that should be in the positive territory. If you look back in 2007-8, those time frame, or just after during taper tantrum, etc., when the consumer was in real stress, you can see that the real wage growth was actually negative. So that hasn't been the case. In fact, that was the case in 21-22 when the inflation was really high. But still, right now it is at, I think, 1.3 or 1.4%. Even if you think about, that tariff-induced inflation, if that takes up another 1%, technically, you might still be in the positive territory. We don't know. I mean, because there is second-order impact, as you said. But broadly, these are the data points. What I can say is that still holds pretty well. The third thing is that household debt to GDP. Okay, so if you look at household debt to GDP, that peaked out at around 100%. in 2007-8 timeframe. Now, right now it is actually sitting at quite low at around 70% or so, right? So it's close to where it was in 2001, 2002. This is important to understand because um, what we have seen in last 2.5 years, it's true that the consumers are not, splurging money everywhere, right? So they have been very cautious in where they're spending, what kind of items they're consuming. But at the same time, if they're not highly levered, the chance of them falling off cliff is actually much lower. So yes, you can go through a period of slowdown, but if you're not levered, right, so you can fully still survive reasonably well till the market becomes normal. That is number one. And there are two other data points, JB, that we look at. I have not put it here. One is the credit card delinquency level. So typically, if you look back in the history, I mean, above 4% is the number where it becomes a little bit tough. The consumers seem to be stressed at that point of time. That number is around 3.2%. It definitely went up a little bit in last 6-7 months, but again in last couple of months we are seeing that it is again going back down. That is number one. Number two is around the spread between US 30-year bond yield and the mortgage rate. Okay, so that spread gives a reasonable idea, how the banks they are looking at in terms of the consumers' health, right? So what I have seen historically again is that when that spread is on an upward trajectory, at the same time when the spread is above 3%, that is when there is a signal of stress in consumption. We haven't seen that. In fact, we have seen that spread kind of stabilizing around 2.5 to 2.7% in last 2 years. Okay, so these are the data points I would say kind of giving us some comfort that yes, I mean we're not expecting the consumers to spend heavily, but at the same time, are they going to go into a kind of debt spiral where the consumption completely gets stalled? Probably not, right? So that is on the consumer side. The other side I'm looking at it is again pertaining to the larger companies, right? So what we did is like it's the S&P 500 net debt to GDP. So the 500 largest companies, they are debt to GDP. So that is at the lowest, one of the lowest level actually that I have seen in last again 25 years or 30 years, right? So again, so there are two kind of spending, right? One is consumer spending and then the business spending. So I would say that the large corporations are not that stressed in terms of spending or doing job cuts, right? Similarly, at the same time, consumers also okay. They're not great at this point of time, and they're well positioned to not to get into that debt spiral. So those are the data points, Javid, that are giving us some confidence that it might not go through the most vicious route.
Understood. And particularly the leverage data points. If you think back to 2008-9, it got a lot worse because of the amount of leverage which was in the system going into it. This
That's
time,
right. Yeah, this time actually interesting. I mean, look, I mean, every time the crisis come from a different place, right? But just to put some data here, like almost 38 or 39% of the homeowners in the US are now mortgage free, right? So that's a good thing to have. That number is to be much lower 10 years back.
Interesting. So I think those are all the questions I had. Any closing thoughts you had, Arindam, that you want to share before we jump to Q&A?
Probably two things. I mean, one of the things that I would say is that when we came into this year, so this is something that we follow different kind of data points, right? So if you look at the right side of the right chart, so it looks at the high yield bond spread, and it also looks at the economic uncertainty index, that index we spoke about earlier. So when it came into this year, we were kind of surprised that if you look at this blue line, that was actually remarkably resilient despite the policy uncertainty index going up quite high. That is not something that we are used to see, right? If you look at on the left chart, when the typically the market multiples tend to go, like the spreads go higher first um, before the uncertainty index actually kicks in. This time it was actually opposite. We were surprised to see that why the market is not reacting, because there are definitely some uncertainty there. So I would say at this point of time, it looks like if you look at the, now they have kind of, the high yield spread is actually showing the risk that is in the market. So it is actually good. I mean, the market has always different kind of risk. As soon as they get priced in, they become more investable, right? So it is kind of good to know that that finally happened. And then finally, this is just a confession that practically nobody knows. In fact, this is a he just couple of days back, Howard Marks came up with his latest memo. So I just took liberty of copying that. Is aptly named "Nobody Knows" yet again, the title of the memo, and probably this last, the line that I've highlighted here. When the time comes to buy, you don't want to, right? The negative developments that make for the greatest price declines are terrifying, and they discourage buying. But when unfavorable developments are raining down, that's often the best time to step up. So, yeah, I think that's where we stand practically. We don't have any kind of what do you call any kind of globe to see what is in the future, but we're happy that some of the risks are getting priced in.
Thanks, Anand. And that quote does. I've seen a lot of cycles, and I have learned the lesson that this quote talks about. I won't comment on the current cycle and so on, but if you've been investing in whether in US or in India for the last sort of couple of decades, you've seen enough of this to have learned it.
Yeah.
Now, Arindam, with this quote, you took away my first question that I wanted to ask you, which is anyway the most sort of frequently asked question. Given what has happened, is this the good time to start entering into US markets? That's the question that we most frequently get asked. But yeah, you've broadly answered that. But what do you reckon from here? The volatility is expected to continue. Obviously, the nature of the markets is such. But how do you recommend investing from here?
Look, our recommendation has always been that keep a staggered approach when you are not that comfortable around the valuation. But at this point of time, as I said, like probably the risks are much more priced in than it was, a few months back. So probably, I mean, it is probably wise to, maybe put a little bit more than you usually put when the risk is high. And as I said, I mean, you have to be very careful. Like, I think it is a good time to be an active investor because, as I said, like there are a lot of parts in the market which are actually trading at very reasonable multiples. In fact, we are kind of digging through some of those opportunities. So I think it is probably at least for next few months or few years, actually, it might be very good for active investing.
Perfect. So there are quite a few questions in the list. What I'm going to try and do is ask the questions with regards to the portfolio first, and then we'll come back to some macro and what has happened again in some time. But the first question is around portfolio positioning. Where are we currently invested? There's a significant allocation in industrials. Why is that so? And what is your reasoning behind that?
Yeah, look, I mean, so these are classification by geeks. Okay, so when I say industrial, these are not your traditional industrial like EPC companies or anything like that. So we have companies like Heiko, TransDigm, which are industrial, but they're playing into that long-term theme of secular theme of air traffic growth, right? So I would say our positioning is more towards so the way we are looking at the world is the following. So if you think about a sine curve, right, it like this. So the best time to invest in anywhere where you are probably close to bottom. Again, we never know what the bottom is. At the same time, you want to be like which is on the rising path, right? So we're trying to identify companies which are kind of, is a barbell approach. You have certain allocations where, the companies which are steadily growing their earnings. At the same time, we are starting to put more money into work where we think the bottom is likely to be closer, right? We're trying to avoid the ones where we believe that the earnings inflection or the earnings growth is going to slow down massively. So that is the code that you want to avoid. So to your point, I mean, where we are investing, so we are trying to invest in companies where we see a steady growth that is continuing and far from being topish in any case, in any scene. And also we're looking for companies which are kind of in that inflection point.
Okay. And you've spoken about geographic exposure here as well. So do you expect this to change from your portfolio point of view? Bulk of the exposure is in the United States. Do you see this changing anytime soon, given how the situation is evolving?
Look, I mean, we are, I mean, this is a bottom up, we do bottom up investing, and there's an outcome that you see high allocation in the US. So I would say that, it might change. I mean, we do not have any, any kind of constraint that I have to be XYZ% in the US, right? So as I said, like if you find really good opportunities at good valuation, consistent growth compounders, then we're happy to go into other markets. And to your point, I mean, yes, we do see some opportunities, but we have to evaluate that opportunity against our existing ones, right? So it's a call that we might take, but again, we are not that focused that like I have to increase my European exposure or my Canadian exposure like that. It will be an outcome of bottom-up research.
Okay. One of the questions, only from a portfolio point of view, that is being asked is, given what has happened with the Magnificent Seven tech, particularly in the United States during this correction, our exposure there is significantly lower. Even if we compare it from a relative basis compared to benchmarks, I'm sure our exposure is less there. Do you think that is something that could probably go up? What are your thoughts around that?
Well, I'll just give two-line answer here, but Jaibir can take it, more aptly. But yeah,
Sure.
I mean, look, quite possible. Not that we're going to be too adventurous, given that we have concern around cycle for certain companies. But at the same time, we do see a few of them getting reasonably valued, more reasonably valued than they were a few months back.
Just adding to what Arindam said, see on the valuation side, some of these names, if you remember in December, we were talking about being uncomfortable with some of those valuations. Where there things are now, the valuation discomfort isn't really there. That said, some of these are cyclical businesses. We are wary of the cyclical effect of some of this on those businesses. Particularly, if you think of it in three broad cohorts. One is the consumer-facing side of tech, right, which is either dependent on e-commerce or advertising revenue, right, whether that's Google, Meta, Amazon. There, this consumption slowdown would show up in earnings. The second is the enterprise spend side of things, which would be your SaaS or cloud names, so people like Microsoft or Google's cloud business or Amazon's cloud business, where again there would be certain cyclical headwinds which would come up from there. See, what we're starting to hear already is deal signing has sharply slowed down. It's how SaaS sales cycles, which were going fine, seem to be stalling. Right now, these, like both of these, the cloud side, cloud/enterprise side, as well as the consumer side, tend to be shallow cycles. So it's easier to capture them through a valuation. Where it becomes a bigger worry is in semiconductors. Right, that's one area where even though valuations start to look juicy, we tend to ignore them. There we anchor much more to expectations getting beaten up rather than the headline valuation getting beaten up. Typically, if you sort of dial back the clock to 2022, what you saw was very elevated multiples because the market was pricing in no earnings growth on what was already a very depressed earnings base. So headline multiples in this space can be tricky. we're sort of ignoring those. Instead, we're paying attention to where the cycle is heading. Because if there is a shallow cyclical downturn on the enterprise and consumer side, that translates into a sharper cyclical downturn in semiconductors, particularly given that semiconductors are also the more directly exposed to tariffs. Things like cell phones and laptops getting more expensive means that semiconductor demand more directly takes a hit as consumers buy less of those. So that's one area where we're being cautious. With the other two, it's more about being aware of where the cycle is and being particular about the price we're willing to pay.
Sure. A few macro questions. At this point, I would request participants to please type in as many questions as you would want Arindam and Javi to answer. We'll be happy to answer as many of those. But Arindam, given what has happened, at the end of the day, it's a tariff. That means goods going to United States become slightly more expensive than what they usually were. This is in a way an intention to probably bring in production on ground in US. Given that we are investing in United stocks companies, do we see this kind of thing happening anytime soon, or are some signs visible for this?
Look, this is very hard to say. In fact, it is going to be slow. It is not going to be overnight. That is for sure. In fact, if you think about what happened in 2018, the outcome around industrial spending or things like that was actually minimal eventually, right? It created few jobs for sure, but the net impact was not that great. Having said that, this time, the focus is much more stronger. There is no doubt about it. But to your point, those moving factory from one country to relocating that to here, those are not an overnight thing. So to put it fairly, it is kind of a consumption tax, right? Before everything moves back to US, and as I said, it's long-term process. As a consumption tax, of course, that definitely increases the burden on consumer to some extent. It will be shared. It is not that the US consumer will only be spending that. It will be shared among, the currency can actually get stronger. The US dollar, theoretically, that is the case. Practically, it plays out differently many times, but theoretically, the currency can get stronger. Some of the hit might be taken by the producers, right? So again, these are slow-moving things. In terms of the investment impact in the companies that we invest in, as I said, like our typical strength is to identify niche which are growing at a steady pace, and I shouldn't say they are not dependent on macro. Everything is macro dependent, but the reliance is much more lower. And each of these franchises are actually kind of very dominant in whatever they're doing, and they are kind of a necessity in whatever they're doing, right? So I think irrespective of the outcome, unless it is really, really draconian, the companies that we have invested in largely should be better than the average.
Just to add something there. So one thing which is different between, say, the 2018-19 period to now is, if you think of the last 5 years, there has been this narrative post-COVID of nearshoring, of reindustrialization. Right? There's been, if you think of sort of the subsidies that the US government has given to chip companies to set up manufacturing in the US, the supply chains that need to grow around that. And so this feeds into what is an existing slow, steady wave of reindustrialization. What it changes more dramatically is how much of that reindustrialization actually goes into the other NAFTA countries versus only the US. What the government now seems to be particularly doing is that everything should come into the US, whereas so far it was everything should come into NAFTA. I think that's one change which has happened, but the direction in which things have been moving, the tariffs just add to it.
In fact, I remember in one of the presentations we've mentioned Warren Buffett saying never bet against America. And so there are a few questions on do you still feel the US exceptionalism will continue to stay post what has happened, or do you see there is some sort of a trust deficit when it comes to this investing in the Western world? I don't know, what are your thoughts around this?
It's a tough one. I mean, I'd say it this way. Every few years or every few decades, we do see this question coming up, right? If you think about, 1980s, it was Japan. Then again, 90s, US got their throne back. Then it was emerging market, right? Then again, US kind of got it back. So I like, like our companies, you might have seen, I've spoken about this many times. We like companies that has the ability to fight back. Okay, so that is where I think US kind of stands out. That is what makes it, that going back to what Warren Buffett said, that, short term, something might happen, some other country should and might take over. But in longer term, the ability to fight back is very unique to US, right? So that is what I think is important for us if you're taking a longer term view. And as I showed you, you remember that data point that I showed you in terms of long term EPS growth, right? So eventually, remember one thing. We should not get confused between how much of market cap one country is adding versus how much of value you are creating for your shareholders. Those are two very different things, right?
Correct.
So if you think about what China's market cap at country level was there in 30 years back, compared to where they stand now, the market cap they have added is actually humongous. There's no comparison. No country did that, right? But if you look at how much of shareholder value China created, if you just invested in their index 30 years back, is the way now, that is where it pales, right? So when you think about shareholder value creation as a public equity investor or as a minority investor, the focus should be in two things. Number one, what is the return on equity that country gives you, right? So that is a function of many things. How protected is your wealth, right? And number three, that will eventually translate into the EPS growth, right? So these are the important things, and if I put them together, you'll get moments of time like certain market doing good for maybe a few years, but broadly, I think where US stands, uh, I would say the story is still quite compelling for long-term investors.
You mentioned China, Arindam, so I have to ask you this question. The reversal of tariffs did not happen for China particularly. The standoff continues to remain. So how do you see from Global Equities portfolio point of view? Participants, please note this is a developed market equities portfolio, so we do not invest in too much into the emerging markets. But from a China point of view, from an investment destination point of view, is there still some merit in looking at it? And in general, from economic disruption point of view.
So you're talking about investing in China?
Yeah, that's one of the questions that we keep getting asked. It's there in the chat box as well.
Look, I mean, as I said, I mean, we don't look at the market that closely. What we like about the market is that it is actually a huge market for any company to be in terms of, like for example, one of our investing companies, Armies, right? I mean, this luxury bag manufacturer, they have a huge exposure to China. So we like, to be in that market given the sheer size of it. But from investment standpoint, at least since I have looked into it, my feeling has always been that, there's a market which gives you a return on equity of around 10-11%. It's an emerging market country, and if a country is giving you 10-11% ROE, so you're basically tied to the fact that you have to time the market really well.
Correct.
I don't think that nothing has happened so far that view is supposed to be changed, right? So I mean, I understand. I mean, From September, I think the market actually rallied back quite a bit. And probably I'll still attribute that to it was just too cheap to ignore. Now again, it is probably back to a long-term median. So this market has to give you earnings growth. Now you can make a case for earnings growth that last 2 years they have been in a down cycle, so there can be some earnings acceleration. But when you think about, okay, can this market really produce an earnings growth on a sustained basis? I don't think we have seen anything for that matter that can actually support that view.
Sure. There is one question, particularly on the performance of the fund. If you could bring up the slide, Arindam, and I'll ask you the question in the meantime. The question is clarity on the kind of alpha that we've been able to generate by running an actively managed portfolio, and sort of what's been some contribution to this. How have we been able to manage this alpha?
So look, I mean, if I look at it till now, to the end of March, so April was a volatile month, so we have generated around 5, slightly above 5%, I think, net of fees and expenses, right? So that is the alpha. What we try to do is in terms of identifying companies which can give you better fundamental compounding. So if, as I told you, S&P 500 typically grows at around 7-8% in terms of EPS growth, and the additional 1 to 2% is your dividend yield, depending on when you enter the market. So that is around 9 to 10%, right? So we are looking for companies that can compound your total return at around teens. It can be 13 to 16, 15, 16%. So that is one source of alphas, and the second source is definitely through portfolio management. We have kind of tools that are built in house that looks into valuation, that looks into different cycles where we are in the cycle. It also looks into different quantitative exposure like value, growth, etc. So that should add another couple of percent. At least that has added, so far has added around 2 to 3 points of CAGR alpha. So broadly, that is the construct. That's how we get into that kind of mid-single digit net alpha. That's how it has worked out so far for really well. Hopefully, that's what we can do even going forward. Was that the question, Hardik, or I missed something?
Yeah, that was broadly the question.
Just a couple of things that I would want to add there, Hardik,
Sure.
which is for people to know. See, the benchmark has 500 stocks. The portfolio has 30. So a lot of the tools which people use trying to do things like smart alpha and so on, we're not doing that. We're not churning. We're not trading. The core of it is what Arindam talked about. Buy companies with better growth characteristics, put up valuation guardrails around buying and selling those companies, build quantitative tools to help identify them and to help strengthen those guardrails, and don't depend on trying to follow every trend or churning the portfolio too much to get a little bit extra in.
Right. I mean, churn of the portfolio, annual churn is around 22% since we have launched. So 22, 23. So it's a very low churn portfolio. And that includes, portfolio rebalancing as well. So yeah.
Jabir, as usual, there is a question on NVIDIA. I mean, we will never let you go without answering a question on NVIDIA for all our webinars. But given what has happened, with DeepSeek from China, with the current stock market corrections, where are you at with NVIDIA? What's your view there?
Look, NVIDIA is a semiconductor company at its core. Like I said earlier, with semiconductor companies, we tend to ignore multiples unless earnings expectations are at a certain point. Right now, what has happened is, if you look at street estimates or sell-side estimates, they're still very anchored to say where they were 3 or 4 months back. They've not really changed much. If anything, they've gone up a bit. What actual investors seem to be worried about are two things. The first is there are, even before DeepSeek, there was some noise about some NVIDIA customers perhaps not being as enthusiastic about putting up massive amounts of capex as they were. Those noises have accelerated. Amidst market volatility, those noises also tend to get amplified too much. So it's not as if that underlying trend has changed a lot. It's just that the market is paying a lot more attention to it. But that was just the DeepSeek and the normal caution that that some of these big companies were starting to get into around capex. What is still an unknown is this entire cyclical slowdown, that cyclical macro sort of slowdown that we seem to be heading into. How will that translate into capex cuts by some of NVIDIA's customers? And if that starts to happen, where do earnings actually settle? And that typically in semiconductors, earnings cuts aren't like the polite 3-4% type of numbers that other companies see. They tend to be quite brutal. So that's something we would watch for. And if you sort of look past it and you say, okay, is AI adoption going to be a thing? Yes, we think it's going to be a thing. It's a way for companies to cut costs. In a cycle like this, enterprise adoption of AI cost-cutting tools will probably be faster than it would have otherwise been. But that's probably not enough to justify the massive amounts of capex which some of these companies were planning. So there is, in this period of volatility, we're not going to go chasing. It's something we keep an eye on as some of these expectations start to settle and things look more reasonable to us. We might get into it, but it's not something we're going to hurry into.
Sure, Javid. Arindam, back to you. There's a question with regards to the current drawdown, and it'll be great if you use the slide in the meantime I ask the question. The potential EPS cut or earnings downward revision, do you think has sort of settled for now, or you see more of this to happen? And subsequently, I mean, the question is, do we get more opportunities to invest, or we should just start staggering from now in view with the earnings downward revision?
So, like typically earnings revisions a little, they lag a little, right? So they don't start immediately. So stocks react first, then the earnings revisions tend to follow. So we have not seen yet, so we came this year, or maybe not this year. So when Trump became president, so the FY25 S&P earnings estimates were around $275 per share. Now it stands at around 270. It is hard to know, it is because of tariff or anything, but or it is just a normal 1 or 2% cut. Typically we see that is not unusual. So it is pretty fair to say that we have not seen the earnings cut yet. Now, having said that, the market is definitely pricing in some, right? So that's why you see this drawdown of going down 17%. That is not a small number. Again, you never know when the market is fully pricing in the earnings cut and all. It is fair to say that market is probably already assuming 5 to 7% of earnings cut, given historically what we have seen. So if that is the case, there you might get an opportunity. I mean but it's very hard to say. So to your second question, it's probably a good time to stagger up, investment.
Okay, great. I'll probably take the last question and try and end it with the portfolio. But given what has happened, the question is around how's our portfolio with regards to sort of direct or an indirect impact of the whole tariff piece that has happened. What's your take on that, Arindam? Impact on our portfolio? While the share price impact is clearly visible on that slide.
So this is, I think, a good guardrail. like we never know, right? I mean, until it happens. So this is a good guardrail that, if the impact on broader market is around 6-7%, the impact on our companies, which is the blue bars, that is probably going to be much lower. So I would say, I mean, again, hard to put any number because we don't know it. But broadly, we are much more, it is actually showing up, as you said, right, in the relative performance as well. The impact shouldn't be that much. I mean, there can be a quarter lag in terms of passing through the pricing and all, but I don't think the impact is going to be that much, all else equal. If the cycles are, kind of has some similarity to the history.
Okay, sure. So participants, at this point of time, if you have more questions, please do write us on invest@marcellus.in, and we'll be very happy to answer those questions. Some of our members from the advisory and relationships team will reach out to you to address your queries, or if I've missed some of the questions. The most important message, Arindam, today is that at the end of the day, most of our investors are fully invested in Indian markets. Whether something has happened or not, the fact is the need to diversify some part of your assets beyond India, taking global exposure or having US dollar denominated assets is not a sort of a temporary or a one-time thing. It's a structural need for participants, for our investors to look at investing in United States. Any views on that, from a long-term perspective, what should be the sort of guiding, return that one could probably expect? While you mentioned about earnings and dividend yield, but if you could, what's a healthy return that one could expect from this kind of investments?
So, I mean, yeah, go ahead, Javish, you're saying something? Okay, so I mean, look, I mean, for this kind of portfolio, I think it is a reasonable expectation to, give around mid-teens kind of return, right? So that's what we're expecting, mid-teens kind of earnings growth. Even if you get a bit of derating here and there, but you still can get a reasonable, healthy compounding. And I think, teens is a very healthy compounding in this kind of market, which is much more stable compared to, most of the other markets in the world, right? So that is, I think, a fair assumption from this kind of portfolios.
Perfect. So the message is very clear. We should consider investing some part of our investments, depending upon our need, depending upon our asset allocation requirements, into these kind of portfolios. Participants, this portfolio is available from Gift City. The name of the portfolio is Marcellus Global Compounders Strategy. As I mentioned, please do write into invest@marcellus.in, and we will be very happy to help you, get you invested into this kind of strategies from our side. But at this point of time, Arindam, there are no more questions. I really thank you and Jabir for patiently answering all these questions. I thank all the participants to log in today. Have a great weekend, everyone. We are good to sign off.
Thank you.
Thank you.
Thank you.